Christian Kulamaji, his story also is interesting because he just started trading with no knowledge, no skill. He was a security guard, essentially. Just that's how he's making money. And he decided, and he took the money he earned as a security guard to trade. And he blew out a few times, and he finally got it. And he started with like 5,000, literally 5,000. Built it up to, at his peak, he was over 100 million. Know where you will get out before you get in. And the beauty of that is it's like literally one sentence. And in that one sentence, it captures 90% plus of risk management. When you are not yet in the position and have full objectivity, decide before putting on a trade, okay, at this point I'm wrong and I'm getting out. Chris Camillo doesn't use any fundamentals. He doesn't use any technicals. My reaction, how's that possible? The reason it's possible because he trades 100% on social media.
One thing I wanted to ask you actually is William O'Neill. He's a big influence for a lot of the people in our audience. I was wondering if there are any interesting stories you remember from talking with him.
The interview was very consistent with what he preaches. This combination of fundamentals and charts and studying historical winners to see what a pattern of a big winner looks like. What he wrote was very consistent with what he talked about. I think people who are very adamant one way or the other and aren't willing to listen to other opinions are probably not going to be good traders, because being a good trader requires being able to admit you're wrong.
All right, welcome back, everybody. It's my honor to introduce the next presenter at the TraderLion conference, Jack Schwager. He needs no introduction, but I'll give one anyway. Jack is the best-selling author of the Market Wizards series, where he's interviewed the world's top traders to uncover timeless lessons on psychology, risk, and strategy. His work remains essential reading for serious investors and market professionals alike. Jack, first of all, great to have you here. Thank you so much for the time. Welcome.
Thank you. Appreciate it.
Yeah, of course. Let's dive right in. We'll keep this informal, but I think we're going to cover some great topics today. First things first, if you had to reverse engineer a market wizard, not by personality, but what kind of happened to them in their life, what kind of formative events would you kind of set up? Failures, turning points. What would you have as part of their story?
Yeah, sure. So one thing that I've noticed throughout the years of doing these books. Is that quite a number of these market wizards started out with an interest in markets in high school, which is not normally a time where most people even know about markets. And I remember, for example, Steve Cohn telling me about how he used to go, lunch. He would at lunch go to the brokerage firm to look at the board and stuff like that. And I'm finding that now also. In fact, in this new book I'm working on, a couple of the traders particularly one started as early as 13. So you're getting an interest in markets. And interestingly, sometimes the catalyst is the high school teacher has a trading contest, and that gets people up. So that's one thing. And another thing that's been a common theme is, which was surprising in the first book, but not surprising thereafter because it kept on repeating and repeating, is how many of these people who succeeded enormously completely blew up, completely failed in the beginning. In fact, I would say at least initial failure is much more common than initial success. So I guess there's certainly been people who've been successful from the beginning, and being successful in the beginning doesn't mean that it's not profile, but failure and the ability to recover from that seem to be a big deal.
Do you think that failure is kind of necessary to allow people to understand how they can push risk and really create that performance, or that's something you can learn as well, even if you start out more risk averse?
Yeah, I guess the failure is kind of important in two ways. One, it takes a certain type of personality to be able to overcome and to believe that right. You can bounce back and just to keep going, to be knocked down, to keep going, get knocked down, keep going, that type of thing. So it's important in that respect. The other thing is, and I've heard some traders say that, who hire other traders, say they prefer to hire traders who've blown up before, because if they haven't, they don't have respect for that possibility. So it's important to go through the experience and to know the pain. Actually, good one on this. Ray Dalio is a good example of that. So talked about painful trade where it was like a pork belly trade, and he picked the wrong side, and he was watching every day the market open, limit down. I think he was wrong. Limit down against it. Limit down, limit down, limit down, and that pain sort of that electric shock almost. I don't know if he used exactly those words, but it kind of is paraphrasing the feeling he communicated. That sort of instilled in him the fear that was necessary for risk management to control.
And outside of what we just covered, are there any, looking at the majority of traders you've interviewed, are there any other, key traits, two main traits that many of them share? And, for each of those traits, if some come to mind, are there any market wizards who really embody those aspects of trading?
Yeah, so there's obviously lots of traits, but let's just take two, right, as you asked. So the first one, people, I know people have heard it a million times, but it is the single most commonly mentioned thing that comes up in interviews. It is definitely the thing that if you were to poll all the traders I've ever interviewed, what is the most important thing? I would give you 10-1 odds that the answer would be risk management, one form or the other. So as much as people have heard it before, hey, you've heard it before because it's true. And so if risk management embodiment. Let me take two of the traders. One, sure. Bruce Kovner, who's probably one of the most famous traders of recent times, and he had a line, and this is also out of all the books, this is the one line that is my favorite sentence in all the books, and probably the one that was maybe most influential on myself. And that line, it's 10 words, is know where you will get out before you get in. And the beauty of that is it's like literally one sentence, and in that one sentence, it captures, I would say, 90% plus of risk management. Because when you are not yet in the position and have full objectivity, decide before putting on a trade, okay, at this point I'm wrong and I'm getting out, preferably by putting in a good till cancel stop, then you've defined what your maximum risk is. And you've got risk control on that trade. You are sure the market can gap beyond it, but in most circumstances, you've pretty much defined your risk. So that is a very powerful sentence, and so in terms of embodying risk control, that's a great sentence. The other thing, the other one I would pick would be Peter Brandt, who was an unknown market wizard. So Peter is a chart trader and basically looks for setups where he believes he can get a much better potential return than the risk required to put on the trade. So he'll be the first one to tell you that chart analysis has very little edge to it, but he's basically trying to pick points where he can put on trades, and as Kovner says, know he's going to get out before he gets in. Pick that point where the trade is a failure is relatively small in its risk compared to what the trade will provide if he's right. And so that looking for trades where you can put it on with limited risk, with the risk still being meaningful, that's an important point, because of course you put on any trade with small risk, you just have it closed and you'll get stopped out almost all the time. But the idea is that if you can find meaningful trades that you can put on for meaningful risk that is not too far away.
And was there another trait that really stood out outside of risk management? Was there other one that really comes to mind?
Yeah, I mean, there's lots of traits that stand out, but maybe one that's underappreciated or one that's important is patience. And patience comes into it in two ways. One is waiting for the right trade, and the other is when you're in the right trade, having enough patience to stay with it to its point, to where you realize at least some significant potential, not taking the first day of profits and jumping out if you're right. Now, the person who's kind of the epitome of this, on the patient side of waiting for the right trade, is a fellow I interviewed in Unknown Market Wizards, Amrit Sal. And Amrit is kind of like, I think the title of the, I forget, I should have, I know the sniper is in the
chapter,
title, right?
Yeah.
And it's like waiting for the perfect shot. And throughout that whole interview, he's always emphasizing how important it is not to get distracted by wanting to do something, because two reasons for that. One is those marginal trades, just to be able to do something, are the ones most likely to lead to some loss. But they also distract you from really paying attention and focusing on the key trade, on what is the most important trade. And it's a theme that's come up. It's come up in the interviews I'm doing now. So I'd say he's a good embodiment, thinking in terms of you're waiting for the perfect shot. And he emphasizes that one of the wrong-headed things people have is having a target, percent target every month, because the markets, no matter what your approach is, the markets are not going to provide the same type of opportunities in different situations. So you may be a perfectly good trader, and the market just isn't giving you the opportunities that your particular methodology requires. And if you are trying to meet a return every month when the opportunity isn't there, you're going to end up taking trades that you really shouldn't, and it's not only not going to get you to your target, it's more likely to keep you from your target.
And when you said patience, what came to mind is also how it applies when you're in a winning trade. And I was interviewing a trader that's fantastic, and he talks a lot about letting the randomness of the market work for you, and to get that asymmetric return, once you've worked so hard to establish a position, picked it up at a spot that's low risk and high potential, when it works, you kind of have to be vulnerable to your system and let it work until the trend really ends for whatever your style and objective is. And I think that's a key part of patience as well. So
Yes,
that's fantastic.
I totally agree. And there's a famous line in Reminiscences of a Stock Operator, which many of your listeners probably are familiar with,
Yeah.
which is the protagonist. It's not written by Livermore, but it's about Livermore. And there's a line in there where he says, it was never my thinking that made me the money. It was my sitting. Got that? Yeah. My sitting. And that's exactly that point.
Yeah, excellent. You mentioned a few recent interviews from Unknown Market Wizards. I know you may have started interviewing already for your upcoming book, which I'm looking forward to, but were there any of these recent interviews that really stood out to you outside of what we've already talked about? And I'd be curious to hear why as well.
Like favorite interviews or whatever?
Yeah, favorite interviews.
Yeah, so I'm working on this book now. And by the way, let me just say here that for the first time ever, I'm working with a co-author, George Coyle. And if you want to get into it at some point, we can discuss how that happened. But in fact, he was the catalyst. I wasn't planning to do the book. And it turned out through our conversations, he ended up being the catalyst for doing it in the first place. But anyway, favorite traders. So in this book, actually, there's a couple that are interviews that I think are as good as any I've ever done, and now we've done. And one of them actually is, it's the first time I'm going to have a full chapter with an anonymous trader. And the reason is that, well, he has a phenomenal story, phenomenal record. I mean, this is a guy who literally went from 50,000 to like $500 million. All right, so it's a phenomenal story. He's also an unusual background for a trader. He's a musician, and he also had a number of failures early on. So altogether, that particular chapter is one that I would say is one of my favorites. But right now, maybe the favorite of the ones I've done. There's another chapter in this new book, another one I particularly like, and we're not including any chapters that aren't good, but sort of thinking of which, if I had to pick, are my favorites.
Yeah.
And there's another
Your favorite
one,
children.
Yeah, well, that's not, yeah, favorite children, you're not supposed to have favorite children. But
Yeah.
anyway, uh, Christian Kulamaji, who has a well-known presence because he did a lot of social media stuff and uh, sort of sort of taught people a lot of things. He was very free in sharing his his methodologies, and uh, he did these live sessions for multiple years, where people could watch him actually trade the whole time. And his story also is interesting because he just started trading with no knowledge, no skill. He had graduated. He was a security guard, essentially, just that's how he's making money. And he took the money he earned as a security guard to trade. And he blew out a few times, and he finally got it. And then built it up to and he started with like 5,000, literally 5,000. Built it up to, at his peak, he was over 100 million. And then actually suffered a big drawdown, which he was very honest about talking about it and telling and completely explaining what happened to him and why it happened, and very, very honest in his whole narrative. So that's another. Although he still ended up with a fair, he had a huge drawdown, but still, even if he ended up with only 50 million instead of 100, coming from 5,000 even to 50 million is still a story. And like I say, his honesty was refreshing. And one of the things he said, interestingly, was that he didn't. He's very self-effacing. He said, "I haven't come up with anything original. Everything I do in trading, I've got from somebody else." And he does give credit where credit is due.
Yeah, quite a bit of our audience is inspired by Christian, actually. So I'm very much, I've watched quite a bit of his streams and really looking forward to that chapter.
Yeah,
so that'll be fantastic.
I have to say, I really like Christian. Just, yeah, I love that honesty in that interview. Yeah.
Yeah, excellent. I also want to know, kind of looking back at your whole catalog, which is quite a few market wizards now. Were there any that really stood out in terms of how their edge was unique? We just said with Christian, nothing new is in the markets, but I talked with Chris Camillo from last year, and his edge is TikTok and looking at social sentiment. So yeah.
So really, I have to say there's two. I got to mention two people here, and one you just mentioned, right, Chris Camillo. And for those people who don't know Chris or what he does, and you've kind of given a little introduction there. The amazing thing is, and let me preface this, I went through a whole career in markets, 50 years virtually, I guess. Yeah, 50 years. And before I did this Chris Camillo interview, and my concept was, well, you either use fundamentals or you use technicals or you use some combination of two. That is 100% of the universe. And the incredible thing is, I didn't realize that that's not 100% of the universe. Chris Camillo doesn't use any fundamentals. He doesn't use any technicals. And when people hear that, they kind of say, well, my reaction, how's that possible? And the reason it's possible because he trades 100% on social media. Doesn't need to know, want to know, or need to know the fundamentals, doesn't use charts. He basically just all his trades are based on social media and also picking up social trends. He's using social media. There's a bit of the Peter Lynch approach to his thing, because when he started out, it was a matter of just seeing what trends were happening. Even as a kid, and there was another guy as a kid. He was a high school kid, and he would go to auctions to buy stuff and then resell. He'd find stuff that was underpriced, undervalued, and then be able to resell it. But he talks about going and stopping. He had this thing he always wanted to stop for I think it was an Arizona soda. I'm not sure which one it was. And one day seeing that it was displaced by another brand, and went back to his brother, who was a broker, and said, how can I take advantage of this? And his brother explained options to him. And so he bought calls on the stock, and that was his first trade. So yeah, so he's one. Now the other one, I mean, Chris is completely unique in that, as I just explained, but another person who's completely unique because he literally breaks all the rules was a fellow called Jimmy Balodimas, who was a prop trader for First New York. And I knew about him because my son, first job out of college was got hired as a trading assistant, and they assigned him to Jimmy Balodimas. And my son tells me, Dad, you wouldn't believe this guy. He tells me about him. So I knew he was legitimate because my son worked for him and all that. And as I said, Jimmy Balodimas breaks all the rules. This is a guy not just contrarian, but he has to fight every trend. I mean, and not to his benefit, by the way. People are going to think, well, if it's not to his benefit, he's fighting a trend. How the hell is he? Is he very successful? And the thing is, he was always taking quick profits along the way. So he shorts a stock, and let's say he shorts it at 100, and the stock is going to go to 250. He's dead wrong on the stock, but he shorts it at 100, gets a little break to 99.5, takes a profit. So he's constantly trading in and out. He was so talented at trading around the stock that when the trend was really dead against him, he kind of compensated for most of the loss. And when it wasn't, he was making money. And so I interviewed him in a month where it was one of those months where the market was up. It couldn't put together 3 down days. I mean, 2 down days and then to make a new high. And in the very last day of the month was when I interviewed him. The market, there's some news, and the market rallied, fell 2%. And he was being short the whole time. So the whole month of stock, and he ended up that month near break even, which was great because he was wrong all month long and just made a null back. But so that was his talent, and the reason why he's different is exactly that. He was doing what you shouldn't do, which is fight the trend. And I say in that chapter, my first sentence is Jimmy Balodimas breaks all the rules, and my first sentence that's an introduction, and my first sentence in the conclusion is something along the line, maybe exactly, don't try this at home, literally. And I think because 999 out of 1,000 people who would do what Jimmy's doing would not only lose, but will lose everything. So it's one of those situations where there's, I was going to say, it's not that there's no lessons to be learned. The incredible thing is that despite that, there's a really important lesson to be learned in that interview. And that is that people tend to think of trades as binary, in the sense, you get in an X and you can get out a Y.
Right.
But the real insight here is that it can be tremendously powerful to be able to trade around the position. For example, let's say you buy a stock at 50 and you think it's going to 60. Okay, that's your trade, and then it quickly runs up from 50 to 55. So the idea there is, you could stay with it and hope it goes to 60. But you could also say, okay, I'm going to take profit on a third or half or whatever. And now, let's say the stock keeps on going. What's the worst thing that happens to you? You've made $5 on 50%, and you'll make $10 on the other part. Okay, good outcome. Now, what if the stock pulls back or commodity or whatever it is, pulls back, which often happens. Now, let's say it pulls back to 52. If you had kept the whole position, you're sitting there thinking, hey, I had this $5 profit. Now it's at 52. I better just take the $2 before it goes back and I lose everything, right? So it makes you much weaker. But let's say you sold it at 50, part of it at 55. Hey, you're happy it's going to 52. Now you can put it back on. So this idea of trading around the position is a really good insight, and that comes out of that interview. So while his methodology is one I would say no one should try, that part of it is really important.
Yeah, and if you hold your whole position, it pulls back to 52. You sell, it's going to reverse back to 70 quickly, and you've lost out because psychologically, exactly.
But it puts you in the key idea is it puts you in a much stronger position.
Exactly. And speaking of don't try this at home, what's the flip side of that? Are there any market wizards where their styles seem the most repeatable for not common folk, but traders who want to get good at this, put in the time, all of that? Are there any styles that really stand out?
So a lot of it is very individualistic, and some styles are, a lot of styles are completely not applicable to most people, whether it's somebody like Jim Thorpe, Ed Thorpe, I said Jim Thorpe, thinking football player, Ed Thorpe, who was just a brilliant quant and kept on coming up with different methodologies to get capture inefficiency in the market. That's not going to be applicable to almost anybody. And then there are traders who are very intuitive, and when you have somebody like that, again, it's almost an innate skill. So you either have that type of innate skill or you don't. Right. So and the methodologies all tend to be very different, but I think ultimately, and then you have traders who use fundamentals in a very deep sense. Again, for most people, probably not repeatable because they're not going to do all the work that's involved, or be able to think in those terms. I think of somebody like Kovner, who when I spoke to him all those years ago, was talking about all these different. He was up to speed on all the intricacies of not just U.S. economy, but all key European nations, Australia, New Zealand, even anything. He just had this, and commodities, and interest rate markets worldwide, the whole picture. So again, that type of ability to see all these different factors and how they combine and be able to put it together effectively, again, out of reach, I think, for most people. So I think something like a Peter Brandt approach, which is using charts and trying to identify, and this comes up in a new book also, there are other traders in this new book who use charts, different methodologies of charts, but they find the particular patterns that they see have an edge, because they seem to win much more often than they lose, and they know when it fails where they get out. So right. I think that's a type of approach for people that is probably more within reach than a lot of other approaches.
And when you're preparing for an upcoming Market Wizard interview, what do you do to really make sure you're ready and have the right questions to ask? Do you like to learn a lot about their style ahead of time from different sources, or do you like to go in with kind of a blank slate and just see where the conversation goes? So
in the past, I basically will know just general things, and I want to know basically what kind of trader they are, and so some stuff that might be, when it's a public person, I'll check some of the public things that have been written, or I'll get something. A lot of times these are traders that many of the interviews are individual traders who there is no background. In fact, Unknown Market Wizards, the entire book is like that. They're really right. There is no preparation. It's all going in. So I'd say of those two extremes of doing a lot of prep and going blank slate, I'm probably much closer to the blank slate school. And I go into these interviews with the intention of not with a list of prepared questions. In fact, how could I have prepared questions if in many cases there's no background that I know, right?
Right.
So I basically just try to have a conversation. And most important here, and I tell people this who might be doing interviews, and as the most important thing is to listen to the answers, because I'd say the biggest mistake that unskilled interviewers make is they have a list of prepared questions, and they're so busy waiting for the answer to stop to get to the next question that they're not listening to the answer. And in my experience, most of the good material in the market was the books came not from the first question, but they came from following through, and somebody says something, oh, that's a tangent, and you go off on that tangent. So that's very critical. So I try to have a conversation and listen to the answers, but I don't do much preparation. In fact, preparation before the interviews is definitely well less than 1% of the work. The actual interviews is probably less than 3%, or certainly less than 5% of the work. And most of the work is taking those lengthy interviews and boiling them down into readable chapters.
Right. And how many interviews do you typically have with a market wizard? And is it helpful to see them, 3 months apart, 6 months apart, to see maybe different market situations and all that?
So it's never like that much apart. It might be, but in many cases there are multiple interviews. Steve Cohen was, Ray Dalio was. A lot of them were multi-market. Actually, I go for the book. I don't know if the majority were. I don't think the majority were, but a significant number occurred in more than one session. And then some of them are single sessions, but they tend to be longer single sessions. So it varies. It's both ways.
Yeah, and I actually don't know this. What was kind of your impetus for starting the series? And at the beginning, when you weren't as well known, was it tough to get some of these traders to agree? It sounds like you started out with a lot of traders that you knew already, so that's certainly helpful. But was it tough to get some of the first guests to be interviewed?
The first book, I was enormously lucky to the point that I didn't realize how lucky I was, and that I got, I had very few I don't remember the rejections I had on the first book. But the way that the Market Wizards whole series began, and it didn't begin as a series, I never intended to do a second volume, but so
we're lucky that there was, so it's great.
What's that?
We're lucky that you kept on writing them, so yeah.
Thank you. The way it started is, I was to give the background here. At the time, I was a research director in futures markets, and had been doing that for about 10 years or so. I didn't think there was I didn't think there was a really good book, comprehensive book on futures market analysis at the time. And we're talking now back in this is early 80s. So there were books out, but I didn't think there was really a good comprehensive text. And and this sounds terribly conceited, but I thought I could do a better book than anything that's out there. And that was my motivation. It wasn't to sell books. I just wanted to write the best book on futures markets. And I took a sabbatical. Things worked out conveniently in a way, and I took a sabbatical. And this is pre-PC. I mean, PCs existed. I wrote the book in '83. This was a book called A Complete Guide to the Futures Markets. I wrote that book in '83. PCs existed, but not the way we
Right.
now with all the programming. So you have to be a real tech nerd to be into PCs at that point in time. So I did this all manually. So no word processing, no Excel sheets, and literally remember, I can still see myself with this hand calculator I had, and literally doing multiple regressions by hand on a hand calculator. So it was, and the book itself ended up being like almost 800 pages. So it was a real intensive job, and it took about a year. I never wanted to do. I did end up doing other analytical books, but I didn't intend to at the time. Anyway, so that was that book, and it did pretty well for an analytical book. It got re-released in an updated version in I think it was 2017. Anyway, that book did decent, did well for an analytical book, and another publisher approached me, wanted to have lunch. So invited me for lunch and pitched me on this idea, wanted to do a whole series of books, one on each market, and I could write them directly or be editor-in-chief or whatever. And I was still a research director at the time, and it was also a time problem. But I said, look, I've done it. I don't want to do it again. If I'm going to do another book, I want it to be more of a mass audience book. And he said, do you have anything in mind? And I had this idea of market wizards for a number of years, but because I had a job which was more than an 8-hour-a-day job, I just never did it.
Right.
And that was the market wizard concept, because I did know some great traders, and I thought that would be a neat book. So I mentioned to him, and he said, well, that's great, why don't you do it? So that was the catalyst. I guess I needed a push to do it, because I knew it would be nights and weekends, and for that year where I was working on the original Market Wizards, plus my regular job, it was like it was an intensive work year, and I couldn't do that again now, but at the time I just had tremendous focus, and I could literally sit down and in a night get a lot done. But not lack of sleep and all of that. But that's how it got done, and that was the catalyst. Was really, if I hadn't written the analytical book, the complete guide, I never would have ended up writing Market Wizards.
Well, either for that book or for obviously the sequels, the rest of the series, were there any traders that you really wanted to get a chance to interview that it just didn't work out for whatever reason, whether they passed away or just time crunch?
Yeah.
Anything come to mind?
Sure. I mean, the most obvious example, the immediate answer I have for that is George Soros. I tried multiple times. I never spoke to George himself. I never got past his coterie of interceptors, right? So, so that is the one that, and because George is probably one of the greatest traders of all time, and a very long career and a fascinating life story. So I think it would have been a really good interview, but just was never able to get it.
And doing the books now, first Unknown Market Wizards and the one you're doing now, is there anything that really is different right now by these current traders versus the ones in the past, or really it's just adaptations and the markets might get a little bit faster, but at the core,
Yeah.
they're kind of doing the same thing?
Yeah, interesting. In most books, there really isn't. I couldn't say that there is a real difference in terms of everybody has individualistic styles, and also like Unknown Market Wizards, I interviewed Peter Brandt, and Peter Brandt is my interview him is in the mid-high 70s, right? So it's not like he's a young trader. He's not like it just happens I got around to interviewing for that book.
Right.
So it's not like the later books necessarily have younger traders. However, the current book I'm working on, and which working title, which will probably be the title, is Market Wizards Next Generation. In this particular case, a lot of the traders are younger, and almost all, I think, are 40 or younger. So which, if you're looking for people with sizable, decent length track records, you can't get much younger
than that. Yeah.
Almost everybody in their 30s, right? That you can't push it any further than that. So this is a very, very young group relative to any group I've ever interviewed, which has been always mixed. So that's a big difference. And one thing I noticed in this book, which didn't occur really in other books. I mean, there may be people who did it, but in this case, a number of the traders started the same way, and they started by shorting small cap stocks that had these rallies which were let's call them fundamentally unjustified.
Yeah.
And and eventually almost all of them gravitated to broadening out and doing other things. But I was surprised to see quite a number of these traders did begin with that variation of that same strategy, looking to short the small cap, stock that has some news, which is, let's say news, which is, it's not really news, but it's made to sound like something, and you get a sharp 3-4 day rally, or sometimes only a 1 day big rally. And there are also these stocks that have these very large percentage moves, like they go a few 100%, or even as much as 1,000%, and in 1 to 4 days, and then they completely collapse. So that particular type pattern is one a number of these traders began their career with. And ultimately, like I say, they all expanded to do other things. And in some cases, they kept on doing that as well as one of the strategies. In other cases, they completely abandoned it because they got too big to even bother with it. But so that's one distinct way where this book, the trading methodology in this book is different than in most of the other books, and in all the other books.
Yeah, and speaking of like building a track record, what would be kind of the performance that you'd see that it's like, wow, I have to talk to this person and see what's going on, or even one just performance metric that outside of everything else kind of signals to you, hey, this is a special trader and it might be worth considering this person for the next book.
Yeah, I've got two different ways of looking, or two different things I look for. Either one. Sometimes, rarely you get both. You probably can't get both, but one is a story where somebody takes a small amount of money, and like I mentioned, like the anonymous trader in this new book is a perfect example. 50,000 to 500 million, and actually, there's another trader in this book who's, of all things, most of his career was as an agricultural futures ag trader, which is not the type of market focus you expect to give you extraordinary returns. Again, another example of a guy starts with a small account and builds it to $500 million approximately. So there are a number of these traders that had these. So that type of story where you take a very small amount of money and build it into a tremendous amount, that I don't care how you do it, that's the story. And then the other one is people who have phenomenal return to risk. And I'm not talking now. Most people use the Sharpe ratio. I'm not a fan of the Sharpe ratio, but the one big advantage of the Sharpe, and we can talk about it if you want, but the one big advantage of Sharpe ratio is that everybody uses it. So if I talk in terms of Sharpe ratio, it has, people will have a way of relating to it.
Right.
So I'm not talking about people who have Sharpe ratios of better than 1, which is very good, or if we wanted to, or even 2 or 3. I'm talking people, and Sharpe ratio. The problem here is that I guess I got to back up here. The big problem with the Sharpe ratio is it penalizes upside volatility. And so many of the traders I interview have this great asymmetry where the returns is just so much larger than the losses. So the alternative, there is a Sortino ratio, which at least some people are familiar with. The problem there is everybody calculates it wrong. The Sortino ratio only counts losing months, which is good, and when people calculate it, they use all the data points, which is wrong because you're literally throwing out almost half the data points because you're only using the losses. So if you make the proper adjustment, which I call the adjusted Sortino ratio, it's the statistic I look for. But so the way everybody calculates the Sortino ratio now, it's always higher, almost always higher than Sharpe. But in terms of Sortino ratios, I'm talking about people, traders who have Sortino ratios like 15 or 20, just that type of thing. So incredible return to risk. So either those two. So if a trader makes 15 or 20% a year and has a really high Sortino, that's still extraordinarily good.
Yeah, I think maybe it was with Tom Basso. You mentioned his process is obviously Mr. Serenity, but his ability to manage risk as well set him apart, and just the consistency that's very cool. One thing that's interesting with a lot of the traders I talk to, who are mostly trend followers of growth stocks or momentum style, similar to Christian Kwalamagi, I would say, is their batting averages might be very low, 30%,
Yes,
but
yes.
their average gain to average loss, that's where their edge is really. When you look at all the market wizards, or maybe you've got some cool observations, how important is batting average? How important, what's the most important metric to really focus on there?
Well, yeah, the least important, the least important is is batting average, right?
Yep.
So it ain't baseball. Yeah, and the reason for that is that some of the best traders, as you mentioned, have very low percentage of 30%, sometimes even 20%, but their winners tend to be much larger than their losses, and that's the key. So it's not just it's a combination of two things. It's a combination of what percent of the time you're right, which is what everybody tends to focus on, but it's also very equally important how much do you win versus when you're right, versus how much you lose when you're wrong. And typically, really good traders tend to have very high ratios of their winning size to their losing size. And
Right.
that's what makes them great. It's not that they have a super high percentage of winning trades.
Yeah, it makes sense when risk management is mentioned over and over again, capping your losses. And that was another thing that was interesting with Chris Camillo, is he doesn't use stop losses, right? That's another
No,
thing that's a little bit different.
no,
Yeah,
he doesn't use stop losses, right? Exactly.
yeah,
It's amazing. I mean, yeah.
yeah, unique. One thing I wanted to ask you actually is you might be able to tell by How to Make Money in Stocks, but William O'Neill,
Yeah.
he's a big influence for a lot of the people in our audience.
Right.
I was wondering if there are any interesting stories you remember from talking with him, or some key takeaways that you got from speaking with him when you're doing his interview.
Yeah, so O'Neill was in the very, very first book, in which, I read my own books after I write them, so it's been. But the last time I read that interview was a long time ago. So it's it it really the interview was very consistent with what he preaches.
Right.
So this combination of fundamentals and charts and studying historical winners to see what a pattern of a big winner looks like. He was all, as a personality, he was just a real enthusiast of American capitalism and the
Yeah.
opportunities it provides. But those who are familiar with O'Neill, what he wrote was very consistent with what he talked about.
Yeah, great. And going back to all those metrics, Sortino, Sharp, all of that, it is kind of one of the goals of FundSeeder to be able to kind of bring it all into one place, the data. And of course, you're the co-founder of FundSeeder, which helps traders get capital by uploading their performance. Is that right?
Yeah,
Is that
yeah.
fair?
So,
Yeah.
so just a background. So I was co-founder of FundSeeder. The idea and the real founder was Emmanuel Bellari, he was with ADM at the time, and I consulted on a fund that they had formed, which is how we knew each other. And we were at some conference and having dinner, and he pitched this idea to me. And the idea was that, hey, there's a lot of traders worldwide who have trading talent, but don't have the pedigree, don't have the contacts. They could be in countries which nobody will ever pay attention to. And wouldn't it be a good idea to have a website where these people could load their track records and be verified, and then use that data to as a product for an investment vehicle like a fund, right? So I said, hey, I thought it was a good idea, and anyway, so that's how it started, and all along the way, I should say really my role is pretty much, I'm not involved in the day-to-day anymore. FundSeeder got acquired by RQSI a little less than a year ago. So really, RQSI is now, and RQSI, for people who don't know, most people probably won't, it was founded and is run by Neil Ramsey, and Neil has been investing in traders for his whole life, and some of the famous traders that he was either the first investor seeding it or very early on. Toby Crable, who is probably one of the best futures fund managers out there. In terms of return to risk, by the way, I don't know anybody who's better. Fort is another big CTA that he founded or was an early investor, and others. So anyway, RQSI is now has taken over FundSeeder. So at this point, FundSeeder, the idea, like I said, was to have an investment product, and through RQSI, a few months ago, a fund was launched, and so the idea is to take traders who have signed up through FundSeeder and seem to have particularly exemplary return risk track records and utilize them for this fund product. And the traders could be from any country, could be from anywhere. Right now, it's linkable if you're with Interactive Brokers. You can directly link and everything's updated automatically. You don't have to do anything. If that's not the case, there's an Excel facility where you can upload your own data, and then it's not verified, but you can upload your data, and that's going to be operative. And I spoke to them this morning. That'll be operative sometime in July, and then there'll be additional brokers added. The next one's going to be TradeStation, and after that Schwab, which is obviously a big one. And then after that, I think Ninja Trader, and it'll go on from there. So the idea is it's an avenue which makes it possible for traders in any country, of any background, if they've actually performed, to upload their data or link it to the broker and have an opportunity to be chosen to be able to manage money. So people who would have no access to manage money ever would have an opportunity through the vehicle.
Yeah, great. We'll link that link down below in the description for everybody. Jack, really enjoyed talking with you. It's great to pick your brain on all this stuff. You can see from behind me, you're a big influence on me. And if you haven't read Market Wizards, everybody go ahead. That's my homework assignment to you. Pick it up. Just one last question. Were there any, not necessarily personality traits, but habits or disciplines that might seem overlooked by a lot of people, but actually a lot of the market wizards seem to share? So specifically habits that might seem trivial, but actually can make a big difference.
I guess I'm trying to think. Maybe the one I would say that is underappreciated is flexibility, meaning that too many traders get into a position and just are rigid, and they can't change their mind. And any news that comes out, or any, I shouldn't say news, but any developments that happen, whether fundamental or technical, that are contradictory, that we should give second thought, end up being rationalized. Well, that's not.
Right.
Yeah, this is bad for the trade, but it's already in the market, or whatever the rationalization. But the key thing is flexibility, the ability to change your mind. And the best illustration that I can give of this is Stanley Druckenmiller. And this is a story that goes back to October 16th, 1987. For those of you who are as old as I am, or not quite that old, but may relate, know where this is going. But this is the Friday before the great crash in October 1987, and on that Monday, the market was down. I think futures, the tape could never catch up. So, but I think futures, which were able to trade, I think was down like 29%, if I'm not mistaken, in one day. And oddly enough, without any real news. But so the biggest one-day crash by far, not only in the U.S. but maybe in most markets. So Stanley at the time was with Dreyfus, and he had been short he was short for most during that period. And on that Friday, and most people who know about this thing, I think picture it as there was this big crash that came all of a sudden. Actually, the market had been going down for months. And not only that, but the week before that big crash, it was a really very weak week. The market went down a lot that week. So Stanley looked at the market on Friday and said, gee, it's down to support levels. It's going down all this much. So what he did is he was heavily short. He covered his entire short position, and then he went long. And not only did he go long, he went leveraged long.
Wow.
So I used to ask when I gave talks, I would ask the audience, anybody ever make a worse mistake? And I stopped asking it because I realized that I couldn't even make up there is no worse mistake. I can't think of a worse mistake. So that sounds incredibly, horrible. And if you looked at his track record, October 87, I believe he was not far from break even. And so how the hell is that possible? How could you make the biggest mistake ever and not be down much, be down an enormous amount? And the answer is that over the weekend, he realized he was wrong. He had this, he was determined Monday morning to come in and get out of this position. So he didn't look at it and hope that it would come back. So Monday morning, unfortunately for him, the market doesn't just open lower, it gaps down 12% right off the open. So he's just switched from short to long, and right off the bat, in the very first second of trading, he's down, and the market keeps on plunging right after that. But what does he do? He basically had orders in to cover his entire position right away, right at the opening. And here's the kicker. Not only that, but he reversed back to short.
Wow.
Right on the opening. So that's the epitome of flexibility. It's not only being able to get out quickly when you're wrong and know you're wrong, but to be able to actually switch over to the other side. But that is the classic example of flexibility, and that's a trait that people often don't appreciate. And personality-wise, I think people who are very adamant one way or the other and aren't willing to listen to other opinions are probably not going to be good traders, because being a good trader requires being able to admit you're wrong.
That's interesting, because I think a common trait that's prized for investors is conviction and belief in your idea and seeing it through. But traders, it's kind of a different situation.
Yeah. You need conviction when justified.
Exactly.
Yeah. But when the facts change, you need to be able to change quickly.
Excellent. Well, Jack, I think that's a great story to leave us with here today. Thank you so much for your time. Again, Appreciate it. To everybody watching, I hope you enjoyed immensely. Check out the links below in the description. If you enjoyed, go ahead and leave a like down below. Subscribe if you're new to the channel. And Jack, thanks again for your time. And we'll see you.
Thanks, Richard. Appreciate it.
Yeah. Thank you. And we'll see you at the next presenter. Cheers.